Mayuresh Joshi, Head of Equity Research at William O'Neill India, is joining us right now on the show. Mayuresh, great to have you as always. Let's talk about a few of these names. Yesterday seemed like a very defensive play. Money went back into some of the bigger IT names. But Tech Mahindra had its analyst meet, spoke positively about FY21 being good for the enterprise business. Near-term challenges on the margin front, but they'll be able to overcome that. Do you feel that while still a defensive pocket, it's a good bet to have some proportion of the money allocated to these IT stocks?
Morning, Devina. Morning, Neeraj. Yeah. So yes, I think some portion should get parked in IT stocks, right? For all the concerns that we keep on talking about, how BFSI is faring specifically in the European markets, with a few bankers actually stating that and the management stating that as well. How these spends will probably happen in terms of the corporate spending specifically on the retail and the manufacturing front in the US markets. Excuse me. I think if you take all that into cognizance, and you probably believe that dollar earnings will still hold up for these companies, albeit at a slower pace than what one really expects over the past few quarters, I think they should still form part of your portfolio very, very selectively again. So,
for what weightage? You would give less than 5% weightage to IT cumulatively?
5 to 8 odd percent, even 10% to a certain extent. But I think you can extend that as the quarter goes by. So I think you start with 5, stay put at 5. We're equal-weighted at this point of time, Neeraj, very frankly.
Okay.
But I think as the commentary will indicate, after Q3 results, you're typically entering into weak quarters for the IT sector as a whole. So I think what management's put forth in terms of the overall macro situation and individually for the balance sheets itself, Devini was mentioning the Tech Mahindra.
Yeah, what did you make of it? I was going to ask you about it.
Yeah, so I think, FY21 obviously is something where they're very, very positive about, right? If you look at the past quarter as well, the wins that they've done on the enterprise business, $490 million odd, when you probably talk about the digital wins as well and the telecom wins as well, $1 billion from AT&T. So I think $1.49 billion in terms of order wins from Tech M. I think that was quite significant. She mentioned margins. Yes, margins did take a hit. But they're curtailing on the SG&A expense. There was a wage hike that they needed to take in the quarter gone by. And they're very aspirant in terms of margins coming back to that 14-15% mark. So as I said, I think it's more of hope that a lot of these managements have. Whether the delivery probably happens from numbers is something that will then increase and enthuse confidence to probably take the weightage higher. So I think 5% weightage for IT stocks at this point of time, overbiased on the large cap names at this point of time.
Are you also overbiased? And for how long does one continue to allocate a chunk of their weightage of their portfolio to financials? I know the going is good right now, and that's, you ride the wave. Sure. But at some point, if you were to sit and dissect your portfolio, you don't want to put all your eggs in one basket, right?
No, you don't. But again, I think where the delivery is coming through and where the earnings is coming through, I think the financials have probably held up far better than the rest of the market. Now, within the financials itself, again, the polarization that has probably happened within a few stocks, I think that probably still continues. I think the institution holding in these stocks still remains extremely high. So unless there is a reason to believe that the earnings deterioration probably continues, and if that probably happens, I think that will spread to the larger market as a whole, because financials probably form the backbone for any economy for that matter. So I think a few of these large cap names have held up because of the quality of numbers that they've exhibited. If by any chance, I think there is any deterioration in numbers, I think that entire trickle-down effect will be felt by financials. If that is felt, I think the trickle-down effect in what we expect in terms of transmission and probably lending out to the lesser stressed out sectors, which probably is happening at this point of time, but the sectors like NBFCs, for example, the lower rated corporates, for example, I think that lifeline also probably goes off. So it might create a multiplier effect, and that's where the whole premise is. I think the delivery from an earnings perspective still continues for these large cap financials. Yes, absolutely concentrated portfolio holdings from institutions, from a few HNIs. But I think that's where I think at least the comfort level lies in terms of delivery of earnings. So I think any number that probably disappoints, I think you might have a massive sell-off for these stocks. But till that point of time, I think you very well continue with these stocks.
Mayuresh, we spoke about IT and when IT tech, etc., is all in focus. We just did a small piece a while back on pharma and how MNC pharma seems to be having an edge. What explains these kind of valuations that an AstraZeneca, for example, enjoys? 87, 88 times FY21 earnings.
I was just hearing Dharmesh and you discussed that, and it's a brilliant piece that you've covered. So I think the premium valuations is based more on the premise of the delivery of new formulations of products that they can probably introduce into markets like this. And again, the pricing related issues probably are absent for these products that they're probably introducing. The second element obviously remains in terms of their balance sheet dynamics, and as Dharmesh was pointing out, I think the balance sheet are extremely strong. So I think the cash on their balance sheets obviously lends a huge support. And again, they're being very, very aggressive in terms of their overall launches, specifically within the domestic markets itself. The third element, obviously, as you rightly pointed out, Neeraj, is obviously going to be valuations, right? And valuations are on the higher side for all these MNC pharma companies. So I think you stack up the MNC pharma companies and you stack up the domestic companies. The domestic companies are saddled with a lot of issues at hand at this point of time. Pricing related issues, FDA concerns in terms of their plants, what they've got in terms of creating a specialty pipeline as far as their R&D expenditure is concerned, which probably takes a huge hit on their EBITDA margins. So I think MNC pharma companies do have an edge over their domestic peers on all these parameters. So I think on one hand, it's justifiable saying that those valuation multiples probably are probably expected to stay put. But on the other hand, my own sense is that a few of the domestic companies can also do well. So yes, I think companies like an Abbott, Pfizer, I think they can be held on by investors who are probably holding on to.
Darshan is going to be mighty upset with you calling him Dharmesh.
Oh, sorry. Sorry for that.
Is the name change happening already?
I was just getting a call from Dharmesh.
Completely understandable these days, but I'm just saying, I mean, because it's good to have some humor. Don't we all need that? Just one small follow-up, Mayuresh, and that is the kind of movement that we're seeing in the sugar space the last few days. What's happening here? Is it the stocks following the global sugar prices and higher exports, or is it something else?
I think it's a combination of 2-3 factors at play, Neeraj, at this point of time. So if you probably look at sugar pricing at this point of time, they've obviously moved up a tad bit. When you're talking about the domestic supply which will come through, the expectations largely are to get curtailed to 25-26. I think those are the figures that ISMA is probably getting out at this point of time. Consumption probably remains the same. The carryover inventory is almost 8 to 9 million tons, which will keep on continuing at 7 to 8 in the next sugar season as well. So it's not that we are going with a deficit in terms of how the sugar season is going to pan out, even for the next sugar season. I think the only positive factor that I probably see is the ethanol blending that is coming through. So I think 3 classes is what the government has done, A, B, C, right? So a lot of emphasis was laid on the C heavy and the B heavy molasses. So I think where the blending comes from and the realizations are expected to come from, C heavy 43 rupees a litre, B heavy you're looking at 48, 49 rupees a litre. So a lot of distillery expansions are happening on sugar companies' end, and a lot of cogen plants are also being put through. So that's a completely integrated model. So I think companies which are in possession of sugar processing, the distillery, which is a reasonable amount of chunk which can contribute significantly to EBITDA, and the cogen processes, which probably takes care of the captive needs in terms of power requirements, I think the realization multiple will be multifold for these sugar companies going forward. It's a cycle that one needs to play out with. Time and again, I think it's a known fact for the markets as a whole. So I think the quality names will probably hold out. So I think Balrampur, for example, might hold out in this entire scenario. They're probably looking at realizations to the tune of 33.5 rupees. The cost that they're holding on to their on their inventory on the sugar side is close to 31 odd rupees. There is a shortage in Maharashtra. I think the extra sugar sales quota is going to come from the UP mills. So Balrampur is going to benefit in terms of the inventory that they hold. So they've got a clear advantage of 2.5 rupees that they're making in terms of sugar as a whole. I think there's an entire piece that we can do. I can speak about it. But I think Balrampur probably holds out. So yeah.
Mayuresh, what do you make out of some of these auto anchs, and what would you do with the battery names, the tire names? Tires have been, tire companies have actually not done anything. Obviously, you would anticipate the same, but the replacement market also is not supporting them.
That's the entire, that's the missing piece, right? Because I think replacement market was supposed to probably hold out the earnings for them, but I think even the replacement market is probably not holding out for them. So clear pressure from OEM side, you're not getting the traction to offset the losses from the OEM on the replacement side. Input costs, again, they have come off. So I think the margin improvement will be evident in this quarter to be witnessed. But I think the overall leverage that you expect to see with reasonable volumes, top line realizations improving, I think that missing piece will not substantiate into significant bottom line growth. So I think, again, I think it's better waiting and watching, I think. No need of rushing into either tire companies or even the battery makers, for example.
Yeah, it's interesting because while Amara Raja YTD has been flat, Exide is down about 30% and despite it having that added pad of that insurance business as well, which everybody said will only add. So this year, 31% downtake for an Exide. And I think these were the businesses which people believe would be EV onslaught agnostic, because even electric vehicles will require business. So they had no reason to get slaughtered even because of the EVs. But somehow the performance has not been that great. Where the performance has been good, Mayuresh, is a very interesting mid-cap or small-cap name, Safari Industries. It's trading at fresh highs. Now we can, VIP, and a lot of this whole talk about how luggage makers would do well, and I can understand VIP doing this, but Safari, in the recent 1 month, has surged to fresh highs again. Do you track this fundamentally?
So I think we used to earlier, but in the current avatar, I think we probably don't track it.
But do you track this space?
Yeah. So I think if you probably look at how air travel is improving multifolds, right, over a period of time, both domestic and international, I think it becomes a proxy play for air travel and the growth thereof. The second element for both these players is the outsourcing that they probably do. So I think the outsourcing element probably reduces a large element of their cost. Now the only equation that they probably need to manage is the forex translation element. But again, if you probably look at the outsourcing element and the expectations again, that they would probably remain far more constant, and if the volumes probably improve for these players, I think the leverage probably keeps on trickling down. So whether it's a VIP or a Safari, the only problem with Safari is the liquidity, because I think liquidity is a huge issue for the stock. No doubt it's done phenomenally well. But again, a large element obviously is how they're probably able to expand the entire piece, right? Because product innovation is extremely critical for players like these. They have introduced backpacks and the other stuff that is required. But I think constant redesigning, re-engineering and all this stuff is probably something which will keep these players in the limelight. So yes, you can probably hold on to these stocks if you probably have them. How the multiplier will come depends on all these factors put together.
I'd heard a very interesting statistic from Sumit Nagar on one of the Alpha Mogul show, that compare the number of backpacks that exist in the country as sold versus the number of bikes that are sold and existing. And usually, I mean, the argument is, the bull argument is that every biker needs a smart-looking backpack as well, and people want a smart backpack now. They don't want a rundown backpack. And therefore, the market for backpacks could really expand. Now, it's an argument, may have some merits as well.
It's like I was seeing a video on, and there has been an innovation in backpacks in the US market itself. So the traditional backpack which you carry on your bag, and if you need to carry the stuff, you need to carry the bag in front of you, open the bag up, right? They've got some levers in place which takes the bag up, it comes right in front of you, you open the bag up, you take the stuff that you want, you pull the lever back up, and the bag goes back.
Wow. Yeah, I think we're some time away from that.
On the price point,
Yeah. Mayuresh, we've seen these big auto names and the way they've performed. Now we're seeing some amount of positive data points coming out. Production from Maruti, they've kickstarted it. There've been price hikes. So all things, like the engine is starting to move a little bit. You feel that this could be the start of the next leg?
That's what my belief is, right? So Q3 numbers might not exhibit what we are probably speaking right now. But if there is sustained improvement on a month-on-month basis over the next few quarters, I think the kind of upgrades that you probably see in terms of expected numbers post FY21, right? Because this is going to be a washout here, even Q4. So I think that will start playing out positively for players like this. All players have taken hikes in terms of the transition to BS6. I was reading a few reports where their whole intention, specifically Maruti, of rolling back their diesel vehicles, and competitors still holding on to that. I think they're probably going to roll that back as well. So to a certain extent, price hikes is going to mitigate the kind of cost push that they probably witnessed on their balance sheets. But again, how volumes play out is going to be extremely critical. Maruti has got all the cars across entry points, right? So I think it stays far more stable on those counts. But again, as I've always maintained with these stocks, I think the move has been there for Maruti from lower levels. I don't mind missing out 5, 6, 7, 8% move. Let those numbers come out. Once I get the hang of numbers and I feel confident, along with what the management feel is and the macro situation improving, I think it's better going all out on these stocks at that point.
5,600, I feel, was a steal for Maruti at that point when it did.
But nobody was willing to take it at 5,600.
Actually, it's hindsight, yeah.
Okay. The other thing is, as I discussed, Mayuresh, that if we can talk about the small finance banks, there are 2 or 3 out there now, and Equitas has filed a DRHP, so Equitas Holdings as a stock is very active too.
Sure.
This pocket has not done as badly as some of the others, smaller names like PCB or Federal Bank have in price performance at least. What do you do here? I mean, what do you like? Why, if anything?
So I keep on liking AU, right? And we've discussed Avas in the past, though not entirely a small finance bank. But AU specifically, I think in terms of delivery of numbers, as you rightly pointed out, I think it's not got affected like the others. So in the past, we've spoken about gold finance companies, for example, when the entire NBFC crisis was looming large. They largely remained unaffected in terms of how the play was. For AU, again, I think the numbers have held out. So I think the assets under management, very, very strong, 6,500 crores, if I'm not mistaken. I think you look at a lot of numbers, so recollection becomes difficult. NIMs and spreads have probably held on. They've contracted a tad bit because the borrowings have probably gone a tad bit higher. The dependence in terms of the mix of borrowing itself, I think is quite diverse for them. The quality of advances they probably do is far more retail centric, which is very, very important in markets like these. The asset quality pressures have not compounded, so they've probably held out. 0.6, if I'm not mistaken, again on the GNPAs, around 0.49 on the net NPA side. So I think they've probably held out on all these parameters that one looks at, and then you stack up the valuations, right? So on a book or adjusted book basis, it probably looks far more expensive than what a lot of these mid-cap private banks would. But again, I think the numbers are probably coming through. Very, very comfortable with tier 1 ratios as well. So I think there is no issues in terms of disbursements and balance sheet growth. Underwriting standards have obviously improved for all of these players. So I think they've probably understood the importance of strong underwriting skills. And they've been doing that over the past few quarters, which is also going to be critical. So yes, I think the valuation stack up probably is on the higher side, but I think AU is something which probably can hold up from an earnings perspective.
Okay. The others, Credit Access, Raymond, Spandana Sphoorty. I mean, these are also great names in their own space. And Spandana Sphoorty, since it's listed, the kind of response that it got, maybe it does not justify what happened post-listing. But would you like this?
They're good stories. They're great stories, even. And if you're probably looking about how the entire play will happen going forward, right? I think these plays will still account if the numbers probably hold true, right? Now, if there is some amount of disruption that probably happens, which doesn't seem to be the case, because what you've gone through the past 4 to 6 quarters, I think that would have got exhibited in terms of some deterioration happening. That has probably not happened. So in my opinion, again, when you've seen a lot of write-offs happen for the banking space as a whole, and there has been a partial deterioration in numbers for all these players combined together, but they've not been as bad or worse off than what the larger counterparts have probably done. So I think a lot of gestation has probably happened in terms of the bad assets at play over the past few quarters. So I don't believe that anything will go sour going forward as well. It might turn out that you've probably done some more recognition on the MSME or the microfinance front over the next few quarters, might just create some amount of a deterioration in the book, but that will be very, very marginal. So I think great stories. I think all these stories might just play out over the next few years as well.
Okay. Shriram Transport Finance, any major implications of this downgrade to ratings?
It might play out on the stock for today's trade, but then again, as we've always seen in the past, right, it will come back to fundamentals.
Somehow this stock tends to bounce back no matter what happens to it, right?
Exactly. So I think it might be a day's reaction, but then it will come back to fundamentals and everybody will start speaking about how FY21 is looking and how the recovery will be. So I think it's more about recovery of numbers and estimates thereof. So I think as history suggests, maybe I think it's a one-day move on the downside for the stock.
Mayuresh, very quickly, 20 seconds, just the name, not the rationale, that one pocket that you're looking out for.
Mid-cap financials.
You are looking out at mid-cap financials. Okay, and I think we discussed some of those names as well. So, but Mayuresh, take a moment to thank you for joining me today. Really appreciate your time.
Thanks.